Talk about the housing market. Let's talk about whether real estate will crash. Let's talk about where the real estate market might head. And we're going to look at monthly mortgage and total interest paid on the same house, but at different interest rates. So basically, what you have here is this extensive move high in the 30-year average mortgage in the US. So you only see that type of extensive move higher back in the 70s. Inflation now hasn't been this high since the 70s. The Fed responds by raising rates. You see an extensive move higher in interest rates. So what that's done to mortgages has made mortgages more expensive because home values have not come down yet. You look back a couple of years ago, February 2019 timeframe, the average monthly mortgage was $1,300. Now we're talking over $2,300 according to this Redfin data. So of course you get variations when you go to certain places like LA, New York City, that kind of stuff, because the cost of living is very different out there. So if we look at a $200,000 home, 5% down payment, interest rate at 3%, you're paying about $1,163, right, a month. Right. Total interest paid, $98,400. Let's round it up a little bit. You take that same $200,000 house, same 5% down payment, but change the interest rate to 6%, which is about where interest rates are right now. Now you're talking $1,500 mortgage. Total interest paid $220,000. The total of your 360 payments, this is a 30-year period, $521,000. You go back, total of the 360 payments made, call it $397,000. So we're talking a $120,000 difference just from understanding how the dynamics of interest rates affect the housing market. So the Fed will raise rates to combat inflation. When you know inflation is high, you know that they're going to start raising rates. Typically, what you see is once interest rates are raised, the value of homes typically come down. The problem is the move has been so fast and so quick that it hasn't hit the housing market yet. We've had a period of well over a decade where you had long periods of time where rates were very low. So assets such as homes have just gone straight up, pretty much. You've had some corrections here and there, like this one, when you tried to raise rates, you had a little correction in stock market, real estate market. But home values have appreciated significantly. Rates were down for a period of time, even going into 2022. So they haven't even been up that long. So it hasn't hit the housing market yet. So once it does, you can expect to see prices cool down because nobody can afford this. Most people can't afford this. You're pricing out a lot of buyers. You start pricing out buyers. You got to accommodate to your audience. You have to bring prices down. Prices come down, then mortgages get more affordable. Home affordability right now is at like extreme highs. I think it's at like the worst. So you can expect the real estate market to definitely cool off. Whether it crashes or not, I can't quite say. We'll have to see how bad it gets. But I would not be shocked if it did. With this type of extensive moving rates, you can expect a very nice cool off, unless things kind of change from here on out. But once this hits the housing market, real estate, interest rates go up, home values come down. So that helps balance out that mortgage so you don't get extremes like this. I think you're at an extreme right now because, like I said, those rates have not hit that real estate market just yet. It's just starting to. We're starting to see values, asking price come down. So next 6 to 12 months, we'll see where real estate goes. But over that period of time, we should definitely see some more cooling and may provide some opportunities. So we'll see what happens. If there's any significant changes, I'll definitely let you guys know. Like the video, subscribe to the channel, and we'll be back with more updates regarding these kind of things in due time.